Hello and welcome back to Dukascopy TV. I'm Natalie MacDonald. Now, in the tough world of bulls versus bears, Bruno Estier is in the studio now to discuss the equity markets. Bruno, thank you very much for coming in.
You're welcome. Hello, Natalie.
Okay, now to get started, what is the situation on the long-term charts for the World Equity Index?
Well, if we look at a monthly chart since 2003, on a world index, basically we all know that we had a big move up to 2007, 2008, and then the big crisis, financial crisis, and then a rebound. And here we are slowly progressing towards the highs of 2007, but we are not yet on a world index basis above this high, which is not the case for the S&P 500, where we are making, for the S&P 500, a new high above 2007. So that makes a split between bulls and bears.
Why is that so?
It is so, and we can see that on the relative strength of the world index divided by the S&P 500. During the period of 2004 to 2007, the world index and the emerging market were outperforming the S&P 500. Right now, since June or beginning of 2011, it is moving down. So it's normal that because they are underperforming, the world index is underperforming, it's normal that they are late and they are not yet at a new high. If we look on the weekly charts, in fact, what we have is since November of 2011, already more than 18 months, or almost 2 years, we have rising highs and rising lows. And right now, in October, we made higher highs above not only August, but also above the June level. And here, by making a new high, we have some kind of a caution sign. Where is that? It is to be seen in the momentum oscillators here on the weekly stochastics, because that one is not making a new high on the momentum oscillators, while it was making a high on the price index. This is what is called a divergence, and that often calls a correction which is a bit longer lasting than the previous one. So it could come to the lower side of the August low or even a bit lower.
So if we're seeing this momentum slow down, then how dramatic is it really?
Well, we can have a look on the daily charts. It is not yet really dramatic. As we see, we have a big move and the retracement is just 25%, a quarter. Of course, the last day is a little bit more impressive, yesterday, but it is nothing terrible as long as it's say above a 50% retracement, so it is about the level of the big mid-September. However, we need to think about what's going to happen next, if it's going to rebound or continue on the way down.
Now, Bruno, if I remember correctly, your long-term cycle combination for the S&P 500, it's not looking so friendly for 2014, is it?
No, it is not. And the question is really, is that just a theoretical view, or is it going to correspond to what the market is doing? If people don't like cycle and you make abstraction of the blue line, then you see only the yellow rising trend line, which is intact and still progressing on the way up. However, if you are more sensitive to the evolution of the price action along cycles, we have here a representation of a 10-year long-term cycle starting in 2002, ending in 2012, and making a new uptrend, if you wish. So the question is obviously, can it go in infinity to the higher sides? Well, there is a combination of the 4-year cycle. This 4-year cycle is also combined with the presidential cycle in the US, with how the time lag for the election from one president to the next, or the re-election of a president. And in fact, the first 2 years after an election is usually the time when, on the policy-making side, you are being more tough and you are more conflictual. You are more lenient just before the elections. You don't want to disperse too much the voters. It's not a surprise to see so much disturbance right now on the political side in the US, but from a technical viewpoint, what we would notice is just the occurrence of this 4-year low in July or October 2014, and because we have not yet corrected for 66 months, we have still the risk to be able to correct something like 25% or a third of the whole rise, which is still a move to 1200 from 1700. That will represent still something like 25%. That's what technicians call a cyclical bear market.
Now, Bruno, you were calling for a fall in the fall, and so far, September is just finished. We're entering into October, and nothing so much really has happened.
Well, you are right, Natalie. It's a little bit disturbing for the statistician or the people who study history. In fact, here we have an example of the monthly seasonality from January to December. And we notice that for a specific set of years, and I will explain that it is only for the post-election years between 1921 and 2009, which belonged to a phase of the market where there was not a big, huge bull market, but just a sideways transition, like in the 66 to 82, like from 2000 to now. So it is really a small subset which is almost data fudging. We are selecting only the years which we like to call secular bearish years. In these years, the annual seasonality is a little bit disturbed and changed to the fact that there is apparently a top in mid-August, which corresponds very nicely to what happened, and a correction which extends beyond September and mid-October into mid-November.
So does this mean that until the end of the year then we're safe, or what are you anticipating instead?
Well, I'm a little bit cautious, frankly. I believe that if we are very lucky, from the current levels of yesterday, we could rebound in the first 10 days of October, but not make a new high, and then start to move sideways eventually further down. I'm not sure that we can totally exclude the fact that we could go along the red path, and the red path would mean continuing sideways on a drift, breaking the clouds, and moving to the support towards the June low. The next 2 weeks are going to be very interesting and revealing.
Bruno, thank you very much. Always great to receive your insight.
Your pleasure.
Bruno Estier there with all of the latest technical analysis on the chart. Stay tuned. We'll be back shortly with more exclusive interviews. Goodbye for now.